Two investors walk into the same bank wanting to buy the exact same commercial property for the same price. One gets approved and other one gets knocked back. Same building, same price, different answer. Why? Because a bank doesn't look a commercial property loan anything like the home loan you are used to. With your house, the bank mostly cares about your salary. With commercial, they are weighing up three completely different things at once: the property, the tenant, and you. And if any one of them is weak, the deal can fall over even when the other two are perfect. Understanding how banks think here is generally one of the biggest advantages you can have as a commercial investor. It tells you how much you can borrow, how much deposit you will really need, and this is a big one: which property the bank will happily lend against and which one it quietly won't. So today I am pulling back the curtain on how the banks actually assess commercial property loans, the three things they test, and one ratio that makes or breaks most deals, and the structural surprises that catch first-time commercial buyers off guard. Now, one important note before we go any further. I am Anita Kumar, the founder of A&P Property Agency, not a mortgage broker or a finance advisor. Everything in this episode is a general information to help you understand the landscape. It's not the financial or the credit advice, and it is not a recommendation about your loan. For anything specific to your situation, please talk to a licensed commercial finance broker or your bank. With that said, let's get into it. Let's start with the mental shift, because if you carry your home loan assumptions into commercial, you will get a shock. When you buy a home, the loan is mostly about you, your salary, your expenses, your credit history. The property is almost a formality. Residential lending is also heavily regulated and fairly standardized. Tick the boxes and answer is largely automatic. You can borrow up to 80 and even 90 or 95% of the value over 30 years. Commercial is the opposite. It's bespoke, assessed deal by deal, not by the rigid formula. The bank doesn't start with your payslip. It starts with the property's income. Can this asset with this tenant on this lease generate enough rent to comfortably cover the repayments? The question comes first. Then they look at the security and then they look at you. So think of it as the bank asking three big questions. 1. Is the security solid? Number 2. Does the income service the debt? And number 3. Is the borrower reliable? Get all three lined up and the money will flow. Let me take you through each one the way lender does. Question 1. Is the security solid? The security is the property itself, and in commercial that means building and lease behind it, because to a bank they are inseparable. The number that captures this is a LVR, the loan to value ratio, or how much bank will lend against the property's value. And here is the first big surprise for a residential investor. On a home you might borrow 80% or 90%. On a commercial, a standard metro property caps out around 65 to 70%. So on 1 million property, the bank lends maybe around 650 to 700k, and you bring the deposit of 300k to 350k plus the additional cost. Commercial simply asks for more of your own money in the deal, and the LVR isn't fixed. It moves with how safe the asset looks. A plain, easy to release property in a strong location, say a tidy warehouse, a shop on the busy strip, gets a higher end, say 70%. But a specialized asset, say like a childcare, a service station, a pub, a car wash, often drops to 55 to 60%. Why? Because the tenant fails. If the tenant fails, a bank asks how quickly can we sell this and get our money back. A generic warehouse suits a 100 buyer, and purpose-built car wash, say for example, suits almost none or few. So they lend less against it. Here is the part that ties straight back to leases. The lease literally moves the LVR. If property leads to a strong national tenant with say 7 years of lease left to run and the fixed annual rent rises, a low risk in the bank eyes. So LVR is full, best pricing. Take the identical building with a wobbly T-net and only 1 year left on the lease, and the bank gets nervous. They might cap the LVR lower, charge a higher rate, or want the loan repaid faster. So same bricks, but the lease changed how much the bank will lend. So the question one in plain terms, the stronger and more relatable property and its lease, the more the bank will lend and the cheaper they will lend it. A professional buyer chooses assets that bank loves because bankability is a part of what makes deal good in the first place. Question 2, and this is the one that makes or breaks most commercial deals. Does the income cover the debt? This is serviceability, and in commercial it revolves around one ratio you absolutely must know. It's called as ICR, the interest cover ratio, or its cousin DSCR, the debt service cover ratio. Don't let the initial scare you here. The idea is simple. The bank takes the property's net income, the rent after outgoings, and divides it by the loan repayments. That gives a number. And banks typically want that number to sit between 1.5 and 2. In plain English, they want the rent to cover the repayments 1.5 to 2 times over. So there is a fat cushion if the tenant leaves or the rate rises. So let's take some examples. Okay, let's make it real now. Say a property earns 100k net a year. You want to borrow. The bank assesses your repayments not at today's rate but at the higher rate. They say it as assessment rate, with a buffer built in, say 8% interest only. On 800k loan, that's about 64,000 a year in assessed repayments. Now do the division. 100k of income divided by 64,000 of the repayment, which is around 1.56. That clears the 1.5 hurdle. The deal services, the bank is happy. But watch, what happens if you try to borrow more? Push the loan to 1 million and your assessed repayment jumps to about $80,000. Now it's 100k divided by 80k, it's just 1.25. That's underlying. The deal fails serviceability even if the property's value would technically allow that loan on LVR. And that's the key lesson. There are two tests, the LVR and the ICR. And the bank lends you the lower of two. Very often it is the income test, not the deposit, that sets your real limit. This is exactly why commercial strong yields matter so much for borrowing. A property on 6% net yield services debt far more easily than a residential property on 3% yield ever could. The income isn't just your return, it's the engine that qualifies you for the loan also. The question 3, is the borrower you reliable? The property and the lease do a lot of heavy lifting in commercial, but the bank still wants to know who is standing behind the loan. They look at your overall financial position, your income, your assets, your existing debts, and your track record. Expect to hand over the paperwork like tax returns and your ATO notice of assessment, bank statements, evidence of your deposit, details of any other loan, and any guarantees you have given. If you're self-employed, they'll ask for your past statements and the business financials. The lease on the property you are buying is part of the file too. The signed lease and any rent review records, because that's the income they are relying on. Here is something that genuinely helps the commercial buyers though. Because the property's income does so much of work, there are low doc, lease doc option for people who can't show the tidy PAYG payslips. Some lenders will assess the deal largely on the strength of the lease and the property's income, a lease doc loan, and other accept the BAS statements instead of the full tax return for the self-employed borrowers. So a business owner whose tax returns don't tell the full story still has a real pathway, and as long as the asset stacks up. A quick honest example of how a borrower piece bites. Two buyers chases the same property. Say buyer A already owns 3 commercial assets, has a clean financial low debt. The bank sees an experienced, safe pair of hands and lend readily. Buyer B is buying their first commercial property, is stressed on other loans and has a messy paperwork. So same building, but the bank wants bigger deposit or a higher rate to compensate. The property was identical. The borrower moved the outcome. So the takeaway on the question 3, get your paperwork clean and your story clear before you go shopping. A borrower who's organized and easy to understand is a borrower bank says yes to. Now, even once you're approved, commercial loans are built differently from your home loans. And these differences catch the first timers off guard. Let me run through the big ones. Short-term loans. Your home loan runs 30 years. A commercial investment loan is often just 1 to 5 years. At the end, the loan matures and you refinance or renegotiate. Sometimes with a balloon where the lump falls due. It doesn't mean you repay it in all 5 years. It means you re-qualify more often. So you always need a plan for the end of the term, not just at the start. Annual reviews. Many commercial loans comes with an annual review where the bank can recheck the property, the lease and your finances each year. If your tenant has left or values have dropped, they can adjust the terms. It is a leash residential loans don't have. Worth knowing before you sign. The assessment rate. Remember the buffer from the serviceability example? The bank doesn't test you at the actual rate. It adds a cushion on top of it to make sure you survive if the rate rose. So your borrowing power is always calculated on a higher interest rate than you actually pay. Don't be surprised when the number comes back lower than you expected. Next one to remember is interest versus the principal and interest. Many investors run commercial loans interest only to maximize cash flow and keep the ICR healthy. Then use the strong rent to pay down the debt or fund the next purchase. Both options exist. The right one depends upon your strategy. And again, that's a conversation for your broker, not for me. Let's talk about what it costs because commercial pricing works differently too. And there is one surprise that trips people up badly. On rates, in 2026, the investment grade commercial deal with the major banks is broadly sitting around 6.5% to 7.5%. If the bank can't be won over, a specialized asset, a shorter lease, a self-employed borrower with a light paperwork, private and non-bank lenders will still do the deal, but wider, often around 9 to 10.5%, plus establishment fees of 1 to 2%. More flexible, more expensive. The stronger your deal, the cheaper your money is. It all comes back to those 3 questions. Also, budget for the process itself. A commercial loan isn't the same day. It typically takes around 3 to 8 weeks, and the big part of that is the bank's independent valuation. The bank will value the property on its own terms, and if the valuation comes in below the contract price, they lend against a lower figure and you have to make up the gap. Professionals always leave the room for that. And now the surprise almost no first timers sees coming, the GST. Commercial property purchase generates or attract GST of 10% on top of the price where residential doesn't. Now in many cases you can either claim it back or deal the structure as a going concern. A tenanted property sold as an operating business which can be GST free, but you may still need the cash flow to fund it in the meantime. This is genuinely important and genuinely not my lane. So please run the GST treatment past your accountant before you sign anything. So let's turn all of that into something you can actually use. If you want the bank to say yes on good terms, here is how make yourself and your deal bankable. Buy an asset the bank loves, a well-located, easy to release property with a strong tenant and a decent lease tail. Bankability isn't an afterthought, it is part of what makes a good deal. Respect the 2 tests. Check both the LVR and ICR early so you know your real borrowing limit before you fall in love with the property you can't fund. Bring the real deposit and the buffer. Plan for 30-35% plus cost and keep the cash reserved for the possible valuation gap or the GST timing. Get your paperwork immaculate, clean financials, tax returns, notice of assessment, BAS if you are self-employed. Organized borrowers get the better answers. And build a team. This is exactly where a good commercial broker earns their keep. As a buyer's agent, we help clients find and secure the right asset. A broker structures the finance. The two roles work hand in hand, and you want both in your team. So let's conclude. When a bank assesses a commercial loan, it asks three questions. Is the security solid? Does the income cover the debt and the borrower's reliability? Nail all three, understand the two tests LVR and ICR, and plan for the structure, the cost and the GST, and you walk in looking like a professional instead of hopeful. Because here is the real secret: the more you understand how the bank thinks, the better the deal you will choose in the first place. Bankability and a good investment are sides of the same coin. A quick reminder of where we fit in this. I am a buyer's agent, not a broker. My job is helping you to find, assess and secure the right commercial property. When it comes to the loan itself, a licensed commercial financial broker is who you want, and I am always happy to point clients towards the good ones. If you would like help finding a commercial property that's genuinely worth buying and worth banking, book a strategy call with us. I am Anita Kumar from A&P Buyer Agency. Thanks for listening, and remember, in commercial property, bank isn't your obstacle. Understand how it thinks and it becomes your partner. See you next week.